Unlike normal markets with metals, the higher the price goes, the higher the demand goes. Usually when price goes higher, we see demand start to fall as a reflection. They say the cure for high prices are high prices, and the cure for low prices are low prices. But this is different. This is an environment where people say, as the price goes up, I was right. The world's falling apart. Better buy more. I'm not selling it. I don't want to go back into cash. There's not enough supply to meet demand, period. You throw into it some sort of an event, whether it be election related, bank related, or market related, very quickly it would be unobtainium. Silver faster than gold, but both actually would very quickly, I think, be impossible to get in any investable form with any expediency whatsoever.
Global gold demand, excluding over-the-counter trading, remained stable in the third quarter at 1,176.5 metric tons, the World Gold Council reported on Wednesday. This steady demand was primarily supported by increased investment interest, which helped balance a decline in jewelry purchases. Spot gold prices have risen 34% this year, positioning gold for its strongest annual growth since 1979. This surge is driven by uncertainty around the upcoming U.S. presidential election, lower interest rates, geopolitical risks, and a trend toward portfolio diversification. On Tuesday, gold reached an all-time high, hitting $2,771.61 per ounce. Total demand for gold, including OTC trades, grew 5% to 1,313 tons in the third quarter, marking a new record for this period according to the WGC. OTC flows alone, investments from institutional investors, high-net-worth individuals, and family offices, amounted to 136.5 tons, nearly double from a year earlier, underscoring growing interest from the investment sector. AndySchectman, CEO of Miles Franklin, cautions that global demand for precious metals may encourage some countries to prioritize their reserves over exports, potentially leading to nationalization efforts and triggering supply constraints in U.S. markets. Demand has surged, compounded by supply disruptions linked to the coronavirus pandemic, resulting in a shortage of small gold bars, which are highly favored by retail buyers. Dealers have responded by offering rare premiums over spot prices, and some have ceased trading altogether due to limited availability. Meanwhile, some dealers have contacted clients to see if they would be willing to part with their gold, hoping to meet the rising demand. Schectman also suggests that gold and silver prices remain artificially low due to short selling on COMEX, creating a disconnect between the physical and paper markets. This suppression, he argues, is driven by banks to support bond markets and maintain low real interest rates, which has contributed to Wall Street's relative neglect of precious metals. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
You have a situation where, first of all, the artificially suppressed price due to the short selling on COMEX and on the futures markets, this disconnect between paper and physical has led to, I think, a severe undervaluation in these metals, and it hasn't been noticed. That could very quickly change, and it's part of the reason why why gold and silver have been neglected by Wall Street, have been neglected by financial advisories, because the price has been suppressed by these banks to support the strength of the bond market, to support the strength of the Western system. Gibson's paradox, the inverse relationship between real interest rates and the price of gold, as an example. But yes, I do think that could happen very quickly, at least on the retail side. You have two North American mints in U.S. and Canada. Mexico doesn't amount to very much. And you have these refineries, a couple of them in the U.S. that don't amount to too much. The rest of the mints, the major ones, let's forget China. You have, other than the U.S. and Canada, Austria, Australia, South Africa, United Kingdom. Those are all across the Atlantic. Rick Rule says you take Joe and Jane six-pack to the Harvard Endowment Fund, you have less than 0.5% allocation to precious metals. You see a major bank fail and it bailed in, where now nothing is safe, where money markets aren't safe, where banks aren't safe. Stock market is overvalued and held up by a handful of stocks. The bond market is teetering due to our massive fiscal irresponsibility and really the lack of appetite for anything of duration in this country, where who in their right mind would buy 10-year or greater, earning 4%? when inflation's, if you really want to be honest about it, running higher than that. But even if, even if you call it there, you can't say inflation's at 3.5% like they want us to believe it's much higher. John Williams of Shadow Stats will tell us it's 11%. And even at 3.5%, if you believe it, so you make 0.5% per year compounding, is that really a good return on a bond that has systemic risk? It has default risk, it has inflation risk. Yeah, I think that people will wake up and say, where the hell do I put my money? And bang, a tiny, tiny fraction of all the money, if even a 2.5% allocation to gold across the whole financial matrix, you're talking a five-fold increase in demand at 2.5%. Most financial advisors will say, fine, 5 or 10%. 10%, you're talking a 20-fold increase in demand. In 24 hours, everything's gone. And when you realize that, all this stuff comes from across the globe in an environment where people are freaking out, at what point do these mints around the world say, maybe we should not send it all to the United States. Maybe we should take care of our own people here or hold it back. Like that's a possibility too, nationalization of some sort. So yeah, I've said forever, and again, it's one of these things I say it and people think I'm full of shit because I'm talking my book, trying to inject fear into the equation so they hurry up and buy, but it's just simple math and logic. Yes, I do think that will happen. As God is my witness, I do. I've been saying it for years. And because I've seen most of my career, we get to this time of the year, right around now, where the mints run out of product and they will not make any current year issue until the next year, 2025 in this case. And they say there's no bull market, Danny, like a metals bull market, because people look around and say, I'm not going back into dollars. I'm not, even if I have a healthy profit. Look, silver's up 40% on the year. Gold's up 35% on the year. Gold is, what was $1,200 an ounce 10 years ago. It's now 27 and change. You've way over doubled your money.
Poland has emerged as the world's largest buyer of gold, adding 22 tons to its reserves in the third quarter, according to recent data. With 420 tons of gold, approximately 16% of Poland's total reserves are now held in the precious metal. Adam Glapiński, governor of the National Bank of Poland, recently stated that the bank aims to increase its gold holdings to at least 20% of national reserves. He emphasized that this growing gold reserve strengthens Poland's credibility, improves its international ratings, and solidifies its position as a serious economic partner. Hungary has also expanded its gold holdings, adding nearly 16 tons in a similar move. Market expert Schectman notes the significance of Poland's approach, seeing it as a proactive measure by the central bank. By accumulating gold, the NBP is preparing for potential disruptions to electronic systems, such as power outages or cyber attacks that could compromise digital financial records. Poland's strategic investment in gold, durable and immune to digital risks, reflects a commitment to economic resilience in uncertain times. Let's get back to the interview.
But there's a man named Adam Glapiński. He is the head of the Polish National Bank. And Poland has purchased a tremendous amount of gold. And maybe number 1 or 2 in the world over the last year or two.
I think they have more gold than the UK now. From my
That's right.
last reading. Yeah.
And I'm going to check one last spot and tell you what he said, because what he said was really, really, really crazy. I want to read the actual thing if I have it. And this is going way too long for normal otherwise. So let me just paraphrase what he said. He said that, to your point, and that's why I'm spending this time trying to find it. He said, the Polish National Bank owns gold because when someone shuts off the power to the electronic accounting system, where all of the financial records are now held digitally, we own gold so that we can, in essence, rise from the ashes of that system. Now, we don't expect that to happen, but it is the duty of the central bank to be prepared for even the most unfavorable outcome. So in essence, he's saying what you are, that the entire system is held in all of the records are held electronically. And that if you see a system go down, an EMP or some form of a cyber attack, you have gold because it's immune to that. And he goes on to say how, it's nearly indestructible. You can pull it out of the ocean 300 years later and it's still brand new. But he, in essence, says, it was strange to me to see the head of the national bank, where they're buying more gold than just about anyone in the world, saying that when someone shuts off the power to the grid, rendering the electronic accounting records gone, this is why we own gold. I found it to be very interesting and highly suspect. So yeah, not a bad idea, man. Not a bad idea at all when you realize that Poland's been buying more than just about anyone, owns more than the European Union now. It's something people should take seriously. You exacerbate that on many levels as as this unfolds, and with all of this divisiveness and all of this chaos, you throw into it, politically charged rhetoric where people think it was stolen, and then you possibly have a banking problem. And it's interesting that the BTFP expires on the 6th. It's interesting that the reverse repo market's almost down to nothing. It's as if the Fed, if they wanted to, could pull the rug on the system to really ignite chaos. Now, I'm not saying that's going to happen, but the timing is very coincidental.
What's the BTFP for people who may not know?
Excuse me?
What's the BTFP for people who may not know?
That's the bank term funding program that was rolled out when Silicon Valley Bank and Signature Bank failed.
The growing global demand for gold highlights its critical role as a stabilizing asset amid economic uncertainties, with nations like Poland and Hungary strengthening their reserves to enhance resilience and credibility. As the demand for physical gold outpaces supply and premiums surge, markets face potential disruptions. At the same time, strategic moves by countries reflect a shift towards safeguarding wealth against digital and geopolitical risks. These developments underscore gold's importance as a store of value and as a hedge against vulnerabilities in electronic and paper markets. How might rising national interest in gold reserves impact the availability and pricing of gold for individual investors in the coming years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.